currently in the political debate, which I realize is not economics and it can never be pure, but there is this discussion of smaller role for government. Government needs to be reduced. What does your theory tell you about that?
To me, it's not the question so much of size as the question of what it does and how it does it. So, for instance, the government should have taken a more active role in regulating the financial institutions, stopping the bubble. That doesn't mean that it needed to be necessarily more intrusive. So I, for instance, when I was in the Clinton administration, I opposed the repeal of Glass-Steagall. And I could say, mild accomplishment. It didn't happen as long as I was there, but there were other forces that were probably more relevant. But it was a very intense battle that we faced. And you look at the arguments that I was putting forward, all the fears that I expressed turned out to be real fears. So that's a simple regulation that says that we ought to separate out the kind of banks that take ordinary people's money and you want to be conservative, and the kind of banks that take rich people's money and want to be aggressive in finding good opportunities. They're two different business models. Bringing them together is risky. So that's not a complicated regulation to write. And it's not intrusive, but it's very effective. So that's an example where it's not the size of the government, but what it does and
doing it maybe smartly or...
Exactly. I mean, another example where when I was in the Clinton administration, one of the things that we changed, an example where we stripped away a regulation. At one point, there was a regulation that every branch of a bank had to be registered. And then they made a little mistake, and they decided that every ATM machine was treated as if it were a bank. Of course, what that did is generate a huge amount of paperwork. The main cost was environmental because you developed computers that would fill out the forms. The forms would be sent to the bottom of some basement. So the main cost was not that great because it was all automatic. The trees suffered, but it didn't do any good. So we said, this is an absurd regulation, and we got rid of it. So you have to be careful. What are regulations that actually protect you, and regulations that say that banks shouldn't be in the gambling business, to me, seem to me a simple regulation that makes a lot of sense. But it's been very difficult to get a regulation that's, the CDSs, the kinds of these derivative products, they may or may not be useful. They may or may not be, they may be insurance products or gambling products, but they're not lending. Right. And so why should an FDIC government insured institution be involved in issuing them? Why should we be underwriting that kind of risky product? And to me, that seems to me a very simple principle, not hard to enforce, but we've had a hard time to get that regulation adopted.
Right. You said that there were no mortgages that were created by the banking system during this period that were actually good for homeowners. And you cited Denmark, I think. You said, look, you can create a mortgage product that deals with people losing jobs, that deals with hard times and keeps people in their homes. But that was never done. Instead, the emphasis was on fee generations and creating situations that created different ways to make more revenues by banks.
Yeah, I mean, that's exactly the point, that the incentive structures got distorted. So, and it got worse in some ways with securitization. And one way to think about this is that in the old model of banking, a bank would originate the mortgage. It then kept the mortgage. If the mortgage went bad, the bank would lose money. So there was a sense of accountability. And with securitization, the new model was based on what I call a fool is born every minute theory. That we with securitization, you originated a mortgage and you asked, can I find some fool around the world that'll buy this mortgage? And if you could, then you didn't care about whether it got paid back. All you cared about was the fee you got when you originated the mortgage. And then we developed, you might say, a whole industry. The mortgage originators originated the mortgage. The investment banks packaged the mortgage. And then the rating agencies believed in financial alchemy. They could take an F-rated mortgage, bless it, and convert it into an A-rated product. I mean, it was better than alchemy of the Middle Ages, where you took lead and converted it into gold. This was real money that they created by this blessing. And then people in Europe and elsewhere assumed that America is a good country, honest people. They don't believe that anymore, and bought these mortgages. When I give a talk in Europe, I always thank the audience for having bought so many of our mortgages. They bought about 40% of it. Just think about that. If they hadn't done that, the downturn in the United States, the problem in our banking system, would have been that much worse. So, the result of this was we developed mortgages that were focused on fee extraction. So you wanted people to roll over their mortgages. You told them balloon mortgages, after 5 years you have to reissue the mortgage. A whole set of products that, when you think about it, were crazy. We developed something, this was innovation, something called liar mortgages, no doc mortgages. So you could manufacture them quickly and sell them. So it was an efficient production. But a little detail, you didn't look at whether they could repay the mortgage. You didn't care because that was not the objective.
Well, it was assumed the housing prices would continue to go up, right?
Exactly.
And so no one would ever have to worry about that.
Yeah, but you knew that they should have known. These financial wizards should have known, because after all, incomes in the United States were stagnant. At the bottom and the middle. All the increase in income in the United States has gone at the top. The data that came out a couple of weeks ago showed that median income, people in the middle, in the United States now is lower than it was in 1997. So we've had, so incomes were stagnant and going down. House prices were soaring. You don't have to have a PhD to know that you can't spend more than 100% of your income in housing. But so this couldn't continue, and so it was just a matter of time before the day of reckoning came. As long as interest rates were low at 1, 2, 3%, the system was working. But the moment interest rates started to soar, you were going to hit a wall. And interest rates, Greenspan had brought interest rates down to a very low level, historically unusual. And to me, it was obvious that at some point they would start rising. When they did, this system was going to all fall apart, because then people couldn't afford it. They would have to start selling, and the bubble would then come crashing down. And that's what happened.